In 1817, Thomas Jefferson, former President of the United States, author of the Declaration of Independence, one of the most influential figures in American history, asked for a book. Not some rare manuscript from Europe, not a groundbreaking scientific text, just a rule book, a pricing guide used by carpenters in Philadelphia. He was denied. The Carpenters Company of Philadelphia, founded in 1724, told him no. The rulebook was for members only. Inside it were the formulas they used to price every stage of construction, the same formulas used to build Independence Hall, Christ Church, and Carpenter's Hall itself. Jefferson, the man who designed Monticello with his own hands, who understood architecture better than most professionals of his time, couldn't access it. That refusal stayed with me. I spent weeks trying to understand why. And what I found had very little to do with carpentry. It pointed to something much larger, an entire economic system that existed before 1863. A system that didn't rely on banks, a system that, somehow, had to be erased. I didn't start with history. I started with a chair. My grandmother left me an oak chair, built sometime in the 1840s. It's heavy, solid, nearly 2 centuries old, and it still sits perfectly level. No wobble, no creak, nothing. I tried to trace who made it. I expected to find a name. Instead, I found a system. The craftsmen who built furniture like that didn't work the way we assume people always have. They weren't paid hourly wages. They weren't taking out loans just to buy materials. They were part of something called the guild system. And once I understood how that system worked, I began to understand why it had to disappear. The Carpenters Company of Philadelphia is still around today. The oldest craft guild in North America, with over 300 years of history. But their members weren't carpenters in the modern sense. They were master builders. They did everything. What we now divide into architects, engineers, and contractors. They handled all of it. When Philadelphia needed Independence Hall, they built it. When the colonies needed a meeting place for the First Continental Congress, they offered Carpenter's Hall, a building they had constructed themselves starting in 1770. And those buildings are still standing. Not as fragile relics constantly repaired just to survive, but as functioning structures, still doing their job. That rule book Jefferson couldn't access? It held something we almost never talk about, a pricing system based on what they called unit pricing. Every stage of construction had a standardized, fair price, not whatever the market would tolerate, not whatever a client could be pressured into paying. A fair price, determined by experienced members known as measurers, and they didn't work alone. At least 2 measurers would assess a project together, making sure no one could manipulate costs for personal gain. The system wasn't designed to maximize profit. It was designed to balance fairness for both the craftsman and the client. And it didn't stop there. Credit worked differently too. Lines of credit between community members could stay open for months, even years. Work could be exchanged for food, for services, for raw materials. Money wasn't always necessary. In fact, according to a 1928 Bureau of Labor Statistics report, early colonial America functioned largely without it. A system of barter dominated the first century of settlement, and currency was scarce, rarely used for wages. People relied on face-to-face agreements. And those agreements did more than facilitate trade. They held communities together. Now, the obvious argument is that this system was primitive, inefficient, a patchwork of local currencies, barter arrangements, and guild monopolies. And historically, that's the narrative we're given. By 1863, we're told, the system had become chaotic. More than 7,000 different state banknotes circulating at once. A $5 bill from New York losing value the moment you crossed into New Jersey. Counterfeits everywhere. And that part is true. The Library of Congress documents over 10,000 unique and legal banknotes in circulation at the time, without even counting fakes. It was messy. But here's what I keep coming back to. The buildings created under that system still stand. The furniture still holds together. The communities built on trust and direct exchange produced things we struggle to replicate today. So when exactly did chaos become the only alternative to centralization? When did we stop asking whether something else might have worked? February 25, 1863. President Abraham Lincoln signs the National Currency Act into law. It passes the Senate by just 2 votes, 23 to 21. A razor-thin margin. This act creates the office of the Comptroller of the Currency and establishes the first true national banking system in the United States. We're taught this was about stability, about replacing chaos with a uniform currency, about fixing a broken system. But when you read the legislation itself, and even the Federal Reserve's own historical archives, the purpose is stated plainly. It was about financing the Civil War. More specifically, it was about increasing demand for federal government debt. Here's how it worked. National banks were required to purchase U.S. Treasury securities equal to 1/3 of their capital. In return, they received banknotes worth 90% of the bond's value. If a bank wanted to issue more money, it had to buy more government bonds. In other words, the entire system was designed to create buyers for federal debt. And then came the pressure. In 1864, a 2% tax was placed on state banknotes. That alone pushed many out of circulation. By 1865, the tax jumped to 10%, effectively wiping out state currencies entirely. And that's where a pattern begins to take shape. Because 9 months earlier, on May 20th, 1862, another law had been signed. The Homestead Act. On paper, it sounded like one of the greatest promises in American history. Any adult citizen could claim 160 acres of public land for a filing fee of just $18. Free land, a fresh start. The American dream, handed directly to the people. Except, it wasn't really free. Historians estimate that actually building a working farm on that land cost somewhere between $1,000 and $2,500. You needed tools, seeds, livestock, materials to build shelter. And as the National Archives puts it plainly, very few laborers and farmers could afford that. So who ended up with the land? Speculators, cattlemen, miners, lumber companies, railroads. Only about 40% of claims were ever successfully completed. The Homestead Act offered land that most people couldn't afford to develop, and the National Banking Act, just months later, created the system that would lend them the money to try. Not coincidence, pattern. And what replaced the old system makes things even harder to ignore. The company town. One of the earliest examples was Lowell, Massachusetts, founded in 1822. But by the 1880s, there were around 2,000 company towns spread across the United States. Entire communities built and controlled by a single company. And workers weren't always paid in real currency. They were paid in script, a substitute that could only be spent at company-owned stores. On the surface, it kept things simple. In reality, it locked people in. The Social Welfare History Project documents what happened next. With no outside competition, prices for housing and food could skyrocket. Workers would accumulate debt they were required to pay off before they could leave. And many never could. By some estimates, 75% of all script used in America was issued by coal companies in Kentucky, Virginia, and West Virginia. People weren't just working for wages anymore. They were working to pay off debts that kept growing faster than they could escape. The system trapped them. The Pullman strike of 1894 exposed just how widespread the problem had become. Over 150,000 workers across 27 states took part. A national commission later investigated and labeled George Pullman's system un-American. But by then, the shift had already happened. The company town had replaced something. It had replaced the guild networks that once regulated fair pricing. It had replaced barter systems that tied communities together through mutual dependence. It had replaced extended credit between neighbors who actually knew each other. All of that, gone. Replaced by a system where your wages could only be spent in one place. And sometimes, I stop and question it. Maybe I'm connecting dots that don't belong together. Maybe the timing is just coincidence. Maybe the Homestead Act and the National Banking Act passed around the same time, simply because Lincoln's government was dealing with multiple crises at once. Maybe company towns emerged because industrialization demanded centralized labor, not because anything was intentionally dismantled. That would be the easier explanation. But then I look at the people who still operate differently. The Amish. Even today, they use a contribution-based system. If someone faces a medical bill they can't afford, they don't go to an insurance company. They stand up during their weekly church gathering and tell the community, and no one leaves until the money is raised. It functions like insurance, but without an outside institution taking a profit. And here's the part that's hard to ignore. They had to fight to keep it. For years, the Amish clashed with the federal government over Social Security. They didn't see it as a tax. They saw it as a form of commercial insurance, something their beliefs forbid them from participating in. In 1965, Congress finally granted them an exemption. But to maintain a system that had worked for generations, without banks, without external institutions, they had to formally request permission. They still have to file IRS Form 4029, an official application to opt out of Social Security and Medicare. They still pay every other tax. They simply refuse to participate in the replacement system. And that raises a question I can't shake. If the old system truly didn't work, why did it have to be made illegal? And if it didn't work, how is it that the Amish still make it work today? There's another pattern I keep running into, one that doesn't show up in buildings or economic systems, but in family histories. Genealogists call it the 1870 brick wall. The 1870 census was the first time every American was officially recorded by name, including formerly enslaved people. Before that point, tracing most family lines becomes incredibly difficult. Records thin out. Names disappear. And then there's the 1890 census, the one that should have filled in the gaps. It was mostly destroyed. A fire in 1896 damaged special schedules. Then, in January of 1921, a larger fire at the Commerce Department building wiped out most of what remained. The surviving records sat there, damaged, neglected, for over a decade. Then, in 1933, Congress authorized their destruction. Gone. And here's the detail that stops me every time. One day before that authorization, President Herbert Hoover laid the cornerstone for a new, fireproof National Archives building. The timing feels almost staged. The same period that reshaped the American economy also reshaped how Americans understood themselves. Before 1870, your identity was rooted in your community, your guild, your relationships, a network of mutual obligation where people knew your name because they interacted with you directly. After 1870, something changed. You became an individual on paper, documented by the federal government, counted, tracked. Your identity tied to records instead of relationships. Your work tied to wages instead of contribution. Your survival increasingly tied to systems you didn't control. And your family history? Traceable. only as far back as those records allow. So I started asking a different question. What if the guild systems weren't primitive? What if they were simply different? Because the evidence is still around us. Furniture that lasts for centuries. Buildings that stand for 300 years. Communities that functioned without constant dependence on external institutions. What if those weren't accidents? What if they were proof? That rulebook Jefferson couldn't access. It wasn't valuable just because it contained pricing formulas. It was valuable because it showed something else. That fairness could be structured. The communities could regulate themselves. That you didn't need a bank sitting in the middle of every transaction. And that idea is dangerous because it challenges something we've come to accept as inevitable. Debt. What if debt wasn't progress? What if it was a replacement? Think about the sequence. The Homestead Act offers land, free land, but most people can't afford to develop it. The National Banking Act creates the institutions that will lend them the money. The company towns create environments where workers depend on wages and often fall into debt they can't escape. And the census, it creates the documentation, the framework that turns people into trackable individuals within the system, each piece arriving within the same window of time, each one reinforcing the others. And I keep coming back to that chair, sitting in my grandmother's house, nearly 200 years old, still perfectly level, built by someone who probably wasn't paid in wages, but in provisions, someone who likely learned their craft through a 7-year apprenticeship, someone who may have never signed a loan agreement in their entire life. And then I look at the furniture we buy today, designed to last 5 years, maybe less, mass-produced by workers earning wages they can't live on, purchased with credit cards, charging interest rates that older laws would have called usury. We call it progress, but the chair still stands, and the questions don't go away. Why do buildings from the Guild era last centuries, while modern structures require constant maintenance? Why was the carpenter's rulebook so guarded that even Thomas Jefferson couldn't read it? Why were critical census records destroyed years after the fire, just before a fireproof archive was built? Why do the Amish have to go to court to preserve a system that worked without issue for over a century? Why do so many American family trees hit a dead end in the 1870s? The same decade the banking system consolidated. The same decade the census became comprehensive. The same decade company towns spread across the country. I don't have definitive answers, just patterns. And once you start to see the pattern, it's impossible to unsee it.